Double the gain, double the pain. We're going to talk about a product that can offer just that, and why you may want to be careful when somebody pitches you that type of product. The product, of course, is a leveraged ETF, becoming all the rage and a disturbing trend. We're going to talk at length about that on this week's program, explain what it is and why you might want to maybe stay away from it despite it becoming ubiquitous in the financial industry. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions, including whether a leveraged product is right for you. Chances are probably not. But anyway, that's what we'll talk about on the program, along with a host of other things as we do each and every week. This, of course, is one of Central Fuller's longest running radio programs, also a top 25 financial planning podcast out there on the World Wide Web. Make sure you check us out on your favorite podcast platform. Once there, make sure you subscribe as well. As always, any trouble finding us, go to our website, nelsonfinancialplanning.com. There you can figure out which icon to click and then get immediately subscribed to our channel. My name, of course, is Joel Garris. Joining me this week, Christina Lamb. As always, a real pleasure to have you on this week's program.
Thanks, Joel.
I always love to do the show with you, and so we have a pretty good time. Both of us, of course, are certified financial fiduciaries at Nelson Financial Planning. Christina, in her own right, is an IRS enrolled agent, and I am a certified financial planner. So we got a broad scope of expertise to share with you on this week's program. But before we do that, we got to mention, hey, it's daylight savings time.
It is, and it seems like it came so much earlier this year.
It did, yeah, but the past week it really was kind of dark in the morning. But man, when I'm going home from work tomorrow, it's just going to be really dark.
Yeah, I'm having a hard time getting my walk in the morning, though, so I'll be happy.
Okay, well, there you go.
I don't like to walk in the dark.
There's the trade-off. But if you woke up thinking, wait a minute, they're not on at their usual hour. Yes, we are on at our usual hour. You just haven't reset your clock. So what I always get confused on this. What is it? It's spring
forward, fall back.
So then that means, in theory, we all should have picked up an extra hour of sleep.
Yes.
And so what was 9 o'clock is now 8 o'clock.
Yes.
So 10 o'clock, so the show normally airs at 9. So 10 o'clock, so it might feel like 10 o'clock, and here we are at 9 o'clock. I think that's right. Yeah. So anyway, how was your Thanksgiving? How was your Halloween? I'm getting confused on the holidays.
Our Halloween was a little quiet this year.
Okay.
My son's 16 now, so he was, getting too old for that sort of thing. And we live on a small block, so not much was going on. But my parents' neighborhood does a big, huge hayride, so we did that the week before. So
nice.
I got my fill of candy and cute little kids running around.
You know, it's funny, in the neighborhood that the kids grew up on, that we sort of moved out of once they kind of moved away, there was always, like hundreds of trick-or-treaters in this particular downtown neighborhood. And then when we moved, we said, we'll have at least some, but we get none.
Yeah, we literally get none at my neighborhood. But at my mom's, we handed out 650 bags of candy.
Wow.
Yes, there's a little get-together just to make the candy bags, and then a get-together to hand out.
You're not talking about like single pieces. You're putting together little gift bags.
Oh, no, they make little gift bags, yes.
That's awesome. It's tradition.
It is tradition.
I loved it when you were a kid.
It is tradition, yes. My son even actually went, and he went for a little while, and then he's like, I think I'm getting too old for this, Mom. I'm like, I think you are too.
Just doesn't want to have to put the stupid bags together. Yeah. And then speaking of Halloween, my goodness, Halloween fell on a Friday, so I guess the office took significant advantage of kind of getting dressed up. So we had two of the staff, and you got to check out our socials for this because the pictures are there. It's hilarious. Two of the team dressed up as me.
Yes, best costume award goes to Zoe and Jamie.
They did a very good job. They had suits on. They had certain of my we'll go with Piccadillys, if you will, pens in the pocket, okay, and then sticky notes and note cards. And see, I got one in my pocket right now. So consistent, and then sticky notes on my phone, which I'm really into. If it's on your phone as a sticky note, there's no way you're possibly going to forget it, right?
Unless if it falls off.
Yeah, okay.
I am a sticky note fan though too.
Yeah, we have the extra strong ones. But then the gents in the office, or four of them, decided to be Teenage Mutant Ninja Turtles. The whole crew of Teenage Mutant Ninja Turtles.
Yes, the whole clan.
Yes, which I guess if you follow the story as sort of the leader, that makes me Rat the Splinter.
Yes.
Or Splinter the Rat.
Splinter the Rat, yes. The sensei.
Yeah.
He was not the leader. He was like the sensei. He guided them. He didn't tell them what to do.
I guess that makes me a rat. Okay, perfect. Well, with that, we're going to get going on to the rest of the program before everybody just turns off the radio dial. So, obviously, we're talking about the growing popularity of ETFs that use leverage, obviously using leverage to juice returns. So we're going to talk a lot about that on the program. Christina, I think you had a pretty good analogy of kind of how all this leverage stuff works when it comes to investing in ETFs.
Yeah. I was kind of saying just leverage is like renting a sports car. It's fast, it's a thrill ride, it's exciting, but, it's really risky because it's probably dangerous. Whereas a traditional ETF, it's more like buying a reliable car that is steady and long-term values. It's dependable. You're not going to get a flat tire or crash or anything like that.
You're putting your 16-year-old not in a sports car. You're putting him in a reliable form of transportation,
yes,
I presume.
Said parents who wanted to give them their old Corvette.
Don't do that. Yes. Anyway, busy week last week in the markets as well. I mean, obviously the Dow, the S&P 500, the Nasdaq, all three indexes hit record highs, and they did that on Tuesday, and then lo and behold, on Wednesday there was a Federal Reserve meeting, which introduced a little bit of volatility, but not really a tremendous amount. But other big headlines, with the U.S.-China sort of trade deal, obviously a lot of trade deals kind of hitting the headlines. Lot going on around the world these days.
Yeah, those trade deals also boosted Asian and European equity markets, which rallied really well this week as well. And Spain has been breaking an 18-year record on the IBEX, which hit its highest level since the global financial crisis in 2007.
Yeah, it certainly has taken a lot of these international markets a long time to sort of recover, yes. Particularly thinking about that statistic you just shared. But I think it's also a good reminder for investors the importance of kind of diversification. And I think what we've seen particularly over the years is that, people are reducing or have reduced down that international component mm-hmm. of their portfolios, and we think that really necessitates sort of a second look in terms of that investment allocation, because let's face it, we do live in a global economy, and a lot of those companies that produce stuff that we use every day are in fact internationally based. So an important distinction in terms of kind of how to think about your overall investment allocation, that's for sure. And then I guess closer to home, some big boys had some big announcements.
Yeah, some earning numbers for the biggies, Apple and Amazon. They beat all of Wall Street's expectations. These monsters have been dominating the markets for quite some time now, starting with their leadership rallies in 2010 during the tech boom, and then it was solidified in 2020 during the pandemic era. I mean, they have just taken off, and an interesting fact was that Amazon was one of the first U.S. companies to hit $1 trillion in 2018 as far as market cap, and then they doubled that to $2 trillion just 2 years later. I mean, that's just astronomical.
Well,
growth.
Now I think NVIDIA broke $5 trillion. I mean, it's some of these numbers and some of these growths, in particular in those small in that small area, which again goes back to that whole theme of important to check your investment allocation. Make sure you're not getting too concentrated on that stuff. Also had some data out about the housing market as well, which showed that home sales went up in September, obviously correlated to kind of the Fed meeting, which we're going to talk a lot about that in the next segment because there's a lot lot to digest there. Obviously, when the Fed meets and they change rates, then there's kind of some winners and losers on that proposition. So we're going to talk about whose side you might be on, depending upon what your activity is. So with that, we're going to take a break and continue here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top financial planning podcast. Check out our website at Nelson Financial Planning to learn more about us, along with how you can connect with any of our social media platforms. And certainly you want to check out our social media platforms this week, because we got some cool pictures from sort of our shenanigans of Halloween on Friday, which featured a host of people.
Absolutely. The whole office contributed.
Yeah.
I was quite impressed.
Very impressed. We had the whole Teenage Mutant Ninja Clan.
Yes.
And then we had a couple of people coming as me, which...
Amazing.
Yeah, exactly. I mean, I mean, how delightful is it to dress up as a middle-aged man with receding hairline? I mean, it's fantastic. Okay. Anyway, my name is Joel Garris, the guy with the receding hairline and middle age. And then joining me on this week's program, Christina Lamb. Both of us are certified financial fiduciaries at Nelson Financial Planning. We're to learn more about the serious stuff that we do. You can check out our website at Nelson Financial Planning and see how we can help you make better decisions with your money. Speaking of decisions with your money, Fed had a meeting this past week, obviously cut rates. That made a lot of headlines. That was probably the big headline for this past week.
Yeah, a quarter-point drop.
Quarter-point drop indeed, and then had the opportunity to join our good friend Simon Conway on his program Good Morning Orlando on Thursday morning, and to kind of discuss some of the things or the implications of what this rate cut meant, along with kind of thinking about what the future may hold. As always, when rates change, there's some winners and some losers when rates change. That's for sure.
Yeah, absolutely. Depending on what you're using the money for, it can be a good thing or a bad thing when rates get cut.
Yeah, I mean, that's true. Certainly on the plus side, when rates go down, that's good for things like mortgage rates. That's good if you're borrowing money for a car. If you're, unfortunately, have some credit card debt, that also means, though, that at least that rate went down from like 24 to 23.75. But still better. Obviously, you know, rate cuts have a tendency to be a little bit more stimulative in nature for the economy as a whole.
Yeah. But on the negative side, if you're just savings money in like a cash account or something like that, then your earnings are going to be going down. So you're not going to be making as much interest as you previously were. And right now there's about $7 trillion sitting in cash out there.
Like a record level.
Absolutely.
And so, all those folks saw their interest that they're making on that certainly go down. And I think that opens up the conversation about, okay, well, what other alternatives are out there in terms of where to kind of invest the money, which is a much bigger conversation. I think we talked at length about that a few weeks back on the program in terms of thinking about other options, like maybe tax-free munis if it's money in the after-tax account. By the way, those don't work very well in a retirement account because, of course, it might be tax-free, but when you take the money out, it's still taxed as ordinary income. So I always like to point that out because you'd be surprised at how many times we've seen like a tax-free muni fund inside of an IRA. It's crazy.
Right. It really makes sense how you utilize it.
Correct.
Definitely in the non-retirement.
No, absolutely. And then, the other part is the rest of the story, right, with the Federal Reserve and kind of its messaging post the rate cut, because the interest rate cut, usually indicates that something's not totally perfect in the economy. And so when we think about kind of the data, you could certainly argue that the unemployment rate, which creeped up to 4.3% in August versus 4.2% for July, not necessarily a great sign. I mean, there could be some explanations involving AI behind that, but old data. I mean, here we are in November, and we're talking about unemployment data from August. There's a bit of a gap in terms of kind of what they were able to wrap their hands around.
Yeah, the government shutdown is definitely impacting things and not getting all that information out there that we should be. And I thought it was interesting too. The Fed chair mentioned that there may not be now a rate decrease in December, so that's leaving some questions in the air. But inflation data was also up a little bit from 2.9% in August to 3% in September. So while those numbers are also lagging due to the government shutdown, it's still a little bit of a decrease there.
Yeah, I think that's part of the problem, Christina. To your point on the government shutdown, is here we are. We're talking about data from August. We're talking about data from September, and sort of somewhat operating in the blind. And I think that's why the Fed chair, after the meeting on Wednesday, really tried to kind of temper down what those expectations might be, because they're really sort of operating in a little bit of a black box. And then you also have all these companies that have been announcing some significant layoffs of late, large companies.
Yeah, I noticed that as well.
Yeah, Amazon was one of the ones that, I mean, there's been a lot of them that have announced this. And it's interesting. I wonder if they're doing that when, like, the data isn't getting reported, right? So,
right, if that's like a true number.
Right.
Yeah.
Right. So you're doing it and you're staying under the radar, so to speak, in terms of kind of how it all...
It's half the information's not there.
Yeah. And then nobody's reporting it, so, must be okay. But that's a significant backdrop that we have to understand and appreciate in terms of where we are in the environment today, particularly when we think about interest rates.
Yeah, definitely.
Yeah. So then, but despite that, the major indexes kept, kind of moving on, and of course this is earnings season, big week for that.
Yeah, absolutely. Earnings, 1/3 of the companies reported this week, plus lots of corporate deals that are going on in the background. So total corporate transactions are up 36% so far this year.
Yeah, and I think that's just kind of representative of the current environment. Obviously, it's a less regulatory environment in terms of the current administration. And so you're seeing that deal making kind of really increase over the course of the year so far. But, again, it does, and this is kind of the theme that we've been talking about so far in the program, is all of this warrants still, to not just put your head in the sand and say, hey, everything's great, my accounts are making money, life's grand. But you really do have to continually check that investment allocation, not just for, under concentration of international or over concentration of some of this AI tech stuff, but also basically the balance between stocks versus bonds, because that also has been changing on you.
Yeah, absolutely. I think that's great advice, because let's say previously your allocation is 70-30, meaning 70% stocks, 30% fixed income. With all the growth we've had, you're more in like an 80-20 allocation, so 80% stocks, 20% fixed income. So you're overweight in your equities, which makes your portfolio a little bit more aggressive than you'd want it to be. So it's important that you either speak to your advisor, look at it yourself, and reallocate as necessary. No,
I think that's very, very, very true. So if you've settled on sort of a 70-30 type of allocation to meet your investment goals and objectives and all of that, and you haven't looked at it for maybe 6 months or 12 months, then yeah, you're kind of probably maybe not all the way to 80-20, but certainly if you haven't looked at it for a year, you probably are, which means that your portfolio has more risk. So that's something that we talk to clients an awful lot in the office on a daily basis about rebalancing. Absolutely. And kind of looking at that overall conversation. Important to kind of really look at that at those details. Yeah. That's for sure.
And that's sort of like an annual checkup. That's something you should be doing, I would say, at least once a year. Always just making sure you're kind of in line with, where you started out being and where you currently want to be.
No, that's exactly right. And I think to sort of segue to our next topic, thinking about the things that you need to look at as an investor and what's important in terms of your finances is this distinction of sort of good debt versus bad debt, and kind of understanding the difference between the two, because obviously these changes in interest rates certainly impact that.
Yeah. So, I thought as we get into that leverage conversation, is borrowing always bad? Or, can it be a secret weapon to help you build some more wealth?
Yeah, no, I mean, I think that's a great way to kind of describe it. Debt at the end of the day is about borrowing money. Leverage is about borrowing money, but not all debt is sort of created equal. And we're going to kind of parse that in a little bit more detail when we get back from this break, and kind of get into the discussion of good versus bad debt, and then sort of segue into how we're seeing it used, unfortunately in a negative way, in more investment products. So stay tuned after the break and hear more here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. Welcome back to the program. Christina, we were talking a little bit about this distinction between good debt versus bad debt, and then we're going to tie it all together with some of the debt or leverage that we're seeing used in a lot more investment products today, and maybe what folks need to be aware of when they're thinking about using those types of investments to accomplish their goals. So, good debt. Give us some examples, if you will, on kind of what that looks like.
Sure. So good debt is when you borrow money that helps build your wealth and equity, increasing your earnings potential. So think of, for example, a mortgage on your home that appreciates over time, or how a student loan can lead to higher income later on in life. So they may not be instant gratification, but down the line, it's helping build your wealth. So a mortgage on a reasonable priced home, as it builds equity and it has more stability in it. Or, for example, a business loan that helps your company grow and hence increases your income stream over time.
Yeah, certainly the ability to use debt is a great way that gives businesses the opportunity to grow at a better rate. And on the flip side, bad debt would be anything that you're borrowing money to get something that ultimately is going to lose value or not really have any value over time, or not necessarily generate any income. Things like using a credit card to pay for a vacation that you can't really afford, or doing some impulse buying, if you will, on that favorite online platform that everybody loves. That can cost you not just the amount that you owe, but also the additional interest charge, which is part of what happens when you have debt of any kind, good debt or bad debt. I mean, there is a cost to having it in the form of whatever that interest rate is. And my goodness, when we look at credit card debt and things like that, the interest rate on some of these is just so high. And I guess that's almost as bad or equally as bad as some of these payday loan stuff that happens. Unfortunately, around town, you see these places where you can get payday loans, and the interest charge is just unbelievable. I mean, so those would be some clear, classic examples of bad debt, which is debt that you want to stay away from. That's for sure.
Absolutely.
Yeah.
Those payday places, I mean, I feel like they're just taking advantage of people.
Yeah,
it's
really
so
are.
harsh.
Yeah.
But good debt, on the other hand, is like using a ladder to climb higher and higher. It'll help you reach new levels, whereas that bad debt, as we were saying, kind of digs you deeper into a hole. And the deeper and deeper you go, the harder it is to get out of that.
Yeah, especially with those high interest rates credit cards. I mean, debt shouldn't be an enemy or something that torpedoes your finances, but unfortunately, all too often it is. You really think of debt as a tool. I mean, you use it wisely. It can certainly open doors. If you use it recklessly, it can, slam them shut pretty quick. And the key, of course, is to knowing the difference. And that's why, when we wrote our book and we then recently published our companion workbook, I mean, that's one of the first few chapters where we talk about debt and the notion of managing debt. And oh yeah, there we go. We got a little
of our new workbook here.
We got a little show and tell, if you will, for our YouTube audience. And but yeah, I mean that's why it's one of the early chapters, and encouraging people to kind of work through this distinction of bad debt versus good debt, because at the end of the day, I mean, it's important to understand the distinction between that, particularly when you then shift gears to kind of evaluating some of the investment products that are out there. And we're starting to see more and more where debt or leverage is getting used in different investment products, particularly within the exchange, the ETF, the exchange traded fund. And so we wanted to kind of really dig into that and talk a little bit about how it works and how it's being used. Discuss some of the pros and cons, as with anything. Any investment sort of has some pros and cons. And then kind of some key takeaways, if you will, along with kind of those disturbing trends that folks really need to kind of really be aware of when we're thinking about these types of products.
Sure. So I think the first step is just kind of going over what an ETF is. I get that question a lot of times on the phone when I'm talking with clients. They're just not quite sure. So an ETF is an exchange-traded fund, and it's basically like a basket of investments. It can be stocks, bonds, or other assets. You buy and sell it on the stock market just like you would a single stock. The beauty of an ETF is that it gives instant diversification, and you're not having to pick individual securities out because they're already commingled together. They often track a lot of indexes like the S&P 500 or the Dow, for example, or you can get an ETF for a specific sector or slice of the market. So within that, there's hundreds of companies. So think about you go to the grocery store and you have your basket, and if you just buy a regular stock, you're just getting like apples or you're just getting oranges. Well, in ETF, you got some apples and oranges, a banana, some grapes, maybe a cantaloupe. You've diversified your basket already. And so it's a collection of different investments, very similar to a mutual fund.
Yeah, no, I think that's a great explanation, Christina. And I guess the next question then is, okay, well, what's the distinction between a mutual fund versus an ETF? You mentioned a key distinction, which is that an ETF basically trades like a stock, meaning that you can buy and sell it during the course of the day, versus a mutual fund, which traditionally will price at the end of the day. So if you say, hey, I want to sell $10,000 worth of my mutual funds and it's noon, well, then the amount or the price per share that you're actually going to be able to receive on that sale won't be determined until 4 o'clock at market close that day, versus an ETF, which you say, hey, I want to sell it at noon. Well, then you can, in fact, sell it at noon. So that's one distinction between sort of mutual funds versus ETFs. The reality is that there's also a much larger distinction. Typically, mutual funds, are often sort of actively managed. They follow, maybe a type of company, or some of them even follow indexes. But if you look at the ones that are following sort of types of companies, maybe that's saying, oh, we're looking at the utility companies, or we're looking at dividend-paying companies. And, I think that's kind of where the distinction comes into play. You mentioned that analogy of kind of going to the grocery store and you're getting all different kinds of, fruit, if you will, apples, bananas, oranges, things like that. And the distinction is that with an ETF, the components of that ETF, all of that fruit, if you will, winds up being a part of that ETF. And it doesn't matter whether if you walked into the grocery store and all the apples were rotten and all the bananas were brown. Because it's a fruit-based ETF, to continue the analogy of your grocery store, then you're going to have the apples, you're going to have the rotten apples, you're going to have the brown bananas, and I think that's kind of the biggest reason why we as a firm sort of lean a little bit more towards the mutual fund side, because that ETF, that what its components are. does not change inside that ETF. So if it's a utility ETF, then it's going to own every single utility company. Well, the reality is some utility companies are better than others. So why do you then have to own all? And that's kind of the limitation, if you will, on the ETF as we see it. So that's kind of the background: mutual fund versus kind of ETF. So now we'll sprinkle in the leverage part of it.
Right. So in finance, leverage refers to using borrowed money or some sort of financial instrument to increase the potential of a return on an investment. Think of leverage as a way to amplify results of your investments, both gains and losses. That's the big key there. Instead of using just your own capital, you now have additional funds, which are unfortunately often borrowed, to invest more than you could otherwise.
Yeah, no, and I think that's a good breaking point, if you will, for the program, because when we come back, we're going to talk about now this concept of leverage that Christina was just describing and how that then gets employed in an ETF to change what you might think is your net result. So we're going to continue here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. So continuing this conversation about leverage and how we're seeing it more and more in some of the investments that are out there that are really kind of seeing a massive increase in the amount of sort of push into the investing public. So Christina, before the break, you were describing a little bit about kind of leverage. We've talked about good debt versus bad debt earlier in the program. And now we're going to kind of, and also along with the difference between ETFs versus mutual funds. And now we're going to kind of bring it all home and explain sort of how leverage is getting put to work inside of ETFs, because these leverage ETFs are obviously very specialized funds that are designed to deliver a multiple of the performance for a particular, maybe it's an individual stock or an index or a benchmark. So if it's 2x leveraged, if you will, that particular type of ETF, the goal is to double the potential gain that you would have from whatever that ETF is linked to, whether it's a single stock or a basket of stocks. But then, of course, the problem is that if it's double the gain, it also is double the loss. Yeah. So give us an example of kind of how that could not be in your favor, kind of how that all works.
Sure. So suppose you have an S&P 500 indexed ETF and it's leveraged by 2%. So if the S&P goes up 1% and you're leveraged by 2, then you've now doubled your earnings on it. However, if the ETF that's tracking the S&P goes down, and the S&P goes down 2%, or 1%, sorry, then you lose 2%.
Right.
So, you're amplifying your gains and losses either way you go as they follow the indexes.
Yeah, and there's also ones that sort of do the flip, right? So the inverse leverage
Correct.
ones, which would sort of deliver the opposite of what it is, and I guess there's a lot of ways in which these funds operate. Obviously, they're borrowing money, and it's the leverage part, but they're using a lot of financial derivatives as well, things like swaps and options and futures, and then the other part of it that I think gets missed is that they reset daily. Right.
That is true.
So the fund is going to so if it's a 2x fund, to use that example, then it's going to reset and rebalance its holdings at the end of every single day to kind of, okay, tomorrow we're going to do it again. We're going to try and do 2x whatever the performance was in for that particular index that it follows.
Yeah, so that's why these strategies are definitely short-term holding strategies. If you hold it too long, it's severely amplifying your gains or losses. They're not meant to be for long-term investments. They're quite short-term. I mean, few days generally.
Well, and that if you're talking about an investment for a few days, that's those aren't the types of investments that we recommend at Notes and Financial Planning. Well, and it just doesn't, financial goals and objectives are meant to be achieved over time. These are not the products that are designed to do that. But here's the thing, and this is why we kind of made a focal point of the program, is the statistics would really start to catch your eye. There is some significant increase in these products in the marketplace, which is why we're talking about it and warning you about all of that here on today's episode of Dollars and Cents. You may want to get some antacid if, as you hear these statistics, and ultimately, in our view, it's just the financial industry attempting to capture more of your dollars with, you can make so much more money than what you otherwise could. Of course, they don't also say, hey, you can also lose a heck of a lot more money. But certainly the popularities of ETFs booming through September 1, total inflows into U.S. ETFs have surpassed the trillion mark, marking the fastest year-to-date increase on record. Monthly inflows into ETFs have run more than 3 times the usual seasonal average every single month this year. And based on the current pace, total inflows for the year expected to pass $1.25 trillion. But there's an issue along with those sort of record inflows, if you will, right?
Absolutely. Along with the record inflows, 115 ETFs launched in September alone, and this year's pace of 77 launches per month continues to sustain in Q4. The total number of launches will surpass 1,000 for the first time. And stop and think about it. If production is getting created so quickly by the financial industry, our experience tells us that it's not good for the investor. You need to stay away.
Yeah, I mean, that's a crazy amount. When you stop and think of about 1,000 new varieties of ETFs that are going to get rolled out to the investor, because they're not making ETFs just to, just make an ETF and, nobody puts any money into it. The point is that they make these new ETFs with the hopes of gathering investor dollars. You start talking about 1,000 of them in just a single year. That's a tremendous amount. And then relating it back to the leverage, here's the little, kind of tweak to it. Of the roughly 800 or so far that have, kind of come online this year, about a third, so a pretty big chunk, are incorporating this leverage into their structure. And then lo and behold, a couple of weeks ago, the financial industry actually filed with the SEC for approval of a leverage that would be 5x a certain single stocks or cryptos or things like that. I mean, previously the highest leverage for an ETF is like, 2x for a stock, for a single stock, 3x for a sector. And now the industry is just going, absolutely nutso and saying, we want these products that are 5x the leverage of how that underlying stock or index performs. That's kind of crazy.
Yeah, it's a lot. It's a lot of leverage. And I think, going over these numbers, it makes it more of a trendy thing to do, not a good financial decision.
Yeah.
And that's the problem with it. So while these products are certainly good for possibly aggressive aggressors or very short-term investing, it's not good for long-term investing.
Yeah, no, and I mean, look, if you're doing it, then I assure you're doing it at your own peril. I mean, this is like day trading on steroids, which in our view has always been. That's just not how you accomplish your financial goals and objectives. The attraction, if you will, of these is that I can juice my return. I can amplify my return. That, after all, is what borrowing money is designed to do. But I mean, these are incredibly short-term types of strategies, because every single day it's getting reset to the particular benchmark. I guess the one thing that it does allow investors to do without actually having to borrow money to do it, because the leverage is internal in the particular product. So it's not like you've got to borrow money on margin or something like that in order to kind of take advantage of. But yeah, my goodness, these are some significant These are some significantly different products than what the average investor is used to. And because of the proliferation, our concern is that they're not just going to proliferate among that very small category of people that would be sort of crazy enough to use them. Other than that, we don't have any opinion. But to proliferate among the investing public as well.
Yeah, and I think social media tying into all this catches trendy things and puts it out there as if it is more for the mass influence instead of a specific type of investor, which leads us to some of the cons of magnified losses. It's not just the gain, so you have to be willing to lose as much as you're willing to gain. The daily reset can also be a negative in the compounding interest. They also have higher costs associated. So if you're thinking between a mutual fund and an ETF, those are definitely, mutual funds are definitely going to be cheaper than a leveraged ETF. And then the calculations are not always the same. So just because it says it's multiplied by 2 times doesn't mean it actually factors out that way when the statistics come to it.
Yeah, I mean, that's a great point, is that if just because it says it's going to be 2x or 3x or whatever it is, doesn't mean that that's what's actually going to happen. Because remember, they're using derivatives behind this product to be able to get to that. And sometimes the derivatives work and sometimes they don't. So some important distinctions. And I guess at the end of the day, Christina, our advice would be, stay away from those. Make sure you're asking the right questions when it comes to your investments. Just a great example of kind of know what you own. Speaking of knowing things, don't forget, set your clocks back because it's daylight savings. And then thank you for listening to the program. This has been Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning. Check out our website at nelsonfinancialplanning.com to learn more about what we do every day to help people make better decisions with their dollars.